Today in our Best in Class, we focus on financials, looking at one of the fund's holdings of U.S. banks. Now, the John Hancock Regional Bank Fund is up more than 70% over the past year, and it is off to a great start so far this year as well, up more than 12%, beating 90% of the peers. Lisa Welch manages the fund and $1.4 billion overall, and she joins us now from Boston. Lisa, great to see you.
Great to be here. Thank you.
Okay, so I looked through your top holdings. Some of them are very big banks, B of A, JP Morgan, also U.S. Bancorp, more of a regional bank. I got to ask you, though, what about regulation? That's a hot topic in financials. I mean, how does that play into your view?
Of course, regulation is going to be an issue for the banks, and we'd like to see the whole thing resolved. But I think that some of the strong fundamentals that we're going to see from the banks over the next few years as credit costs come more into line with normalized times are going to outweigh the regulation that we see. I think that there's still plenty of opportunity for the banks.
Right, but the regulation seems, of course, to be weighted more towards the bigger banks. Does that mean that you might be wanting to, you might want to look more and pay attention to the smaller regionals then?
Well, we do own quite a few smaller regionals. We have about 70 holdings in the fund right now, and we will continue to add in the smaller space, but right now we still see a lot of value in the bigger names also, even given that regulation is going to be, we believe, somewhat harsher for the larger banks.
Right, and does it matter to you if it's the Fed regulating them, if it's the FDIC? Does that matter at all to you or not?
Well, I mean, there are a lot of regulators right now, and so I think having a regulatory structure that everyone can understand. I mean, the Fed already does regulate the largest bank holding companies and all bank holding companies, so I think that having some consistency in regulation will be good for the banks to not have to switch regulators and kind of start all over.
Right.
I think that would be helpful.
Right, that's all that uncertainty then that we've been talking about, Lisa. All right, so, okay, so when you're digging down into the banks themselves, though, I mean, what kind of factors really stand out for you? Because a lot of people say, look, the momentum play is over. We're not going to see the whole sector move up. It's going to be stock picking now.
Right, and I think that's true. I mean, we still have a lot of credit issues to work through in the system, so you really have to dig deep into the asset quality of the banks and look at what the earnings power of the bank is when they come out of the cycle, when credit costs are more normal. And some banks are much better positioned than others.
Like who, for instance?
Well, I mean, you obviously we believe the ones that we hold in the fund are much better positioned. But if you look at the big banks and you talk about normalized earnings, Bank of America, we have normalized earnings, $275, $280 per share, and the stock still looks very attractive to us at the levels it's at now. Or JP Morgan, normalized earnings of over $6.
And who do you want to avoid?
Well, you want to avoid the banks that are going to fail. There's still over 700 banks on the FDIC's problem bank list.
How do you know? How can you tell? Who are they?
Yeah, I mean, you look at capital levels, you look at asset quality, and you make a judgment of banks who are either going to need to raise a lot of capital to survive or who are not going to survive the cycle.
Okay, Lisa, we'll have to leave it there, but good to talk with you. Lisa Welch, portfolio manager of the John Hancock Regional Bank Fund, talking about banks.